Hi, everyone. Thank you for joining me today. Today, we have another webinar for YX Insights. Right now, it is after the market close on September the 17th. We have a lot of ground to cover. We're going to specifically talk about FOMC tomorrow, the decision between 25 basis point of cuts versus 50 basis points. We're going to play a scenario analysis to see what the impact might be on the yield curve as well as on TLT. And then we're going to dive into SPX, SPY, and QQQ analysis, looking at the historical returns. And as usual, at the end, we'll have chart analysis for SPY, QQQ, TLT, Bitcoin, gold, silver, and Magnificent Seven companies. So let's get started. If we look at where the Fed Fund futures are pricing in today, the Fed Fund futures are showing a 38 basis point cut for tomorrow. And that doesn't actually mean the Fed will cut 38 basis points. The Fed will cut a binary 25 basis point or 50 basis point. So the fact that the futures pricing in a 38 basis point cut means there's a basically 50-50 chance that the market thinks will go either way, either 25 or 50. And it's really cutting it close because the FOMC meeting has already started today. So each FOMC member will get to enter their dot plot projection, and also they can revise it tomorrow, and they will vote tomorrow on what they think the appropriate decision is. We'll go through whether I think 25 is more appropriate than 50, and why the market is pricing this way in a second. But just look at the yield curve. Apart from tomorrow, November, December, January meetings also have a very decent chance of a 50 basis point cut. So each meeting has priced in 40 basis points. So more likely or not, the market thinks there will be a 50 basis point cut in each of those meetings. And then the entire rate cut cycle is pretty much done by the time we reach summer. And the terminal yield will be just shy of 3%. So this will be a really quick rate cut cycle if what the market projects becomes true. So this is just visualized onto the yield curve. The Fed Fund futures very steep initially for the next 3-4 meetings, and it becomes shallower, and then there is one cut pricing for the second half of the year. So the big question, 25 or 50? This has been very confusing because the Fed doesn't really like it to unclear guidance going into the meeting. So usually, if the Fed clearly leans towards one way or the other, either the most important Fed speakers, like the voting members or Powell himself, would speak weeks in advance, telegraphing what they think will happen, or if they're in the blackout period, because Fed speakers cannot do interviews 10 days before the FOMC meeting, then something like the major media outlets will start saying the Fed will likely do X, Y, and Z in the next meeting. This is just to align the market expectation going into the meeting so they don't have ugly surprises. And this has been the approach the Fed has adopted since the financial crisis, so since 15 years ago. So whether we get 25 or tomorrow, either way, it's going to be the biggest market surprise for the last 15 years. That's how confusing it has been. It has to be said that the Fed has managed the communication really poorly going into this meeting. So remember, in June, we had a dot plot that suggests we only have one cut this year. And then in July, they decided not to cut. And then we had a really ugly non-farm payrolls report, and that sent everyone panicking and market pricing 50 basis point cuts back to back. And then things start easing back and data start improving again. And then here we are, 25 or 50. And even in Jackson Hole, where Powell had a clear chance to communicate how much he could cut. He didn't. He just said, it's time to start cutting. He didn't really suggest like how fast or how slow, what sort of pace they're going to go at. Just a review of the June dot plot. So and the projections. So the economic projections happen every quarter: March, June, September, and December meetings. So in each of those meetings, the Fed would gather everyone's projection for the next 3 years, and note that this is a calendar year projection. So 2024 in June, so there are 6 months left still. And I think there's four meetings to go. So this reflects what they think for the next 4 meetings. Whereas now in September, we already had the July meeting. So we only have September, November, December meeting. So the flexibility is much narrower going into this meeting. We're going to go through a quick recap of all the data against this dot plot. A quick preview is that unemployment rate currently is a bit high, PCE inflation and core inflation and above more better than the target. So in June, at least half of the people thought we're not going to cut more than once. Even 4 people thought we're not going to have cuts at all this year, right? So let's say the Fed cuts 50 basis points tomorrow. That immediately brings everyone's default position at least below this line. And it's a quite big jump from where people projected in June. And it really makes this whole exercise really ridiculous because how can you go from 3 cuts to 1 cut in 3 months' time, from March to June, and now from 1 cut to, let's say, 4 or 5 cut, 100 or 125 basis points of cuts in another 3 months from June to September. So I think if they move too fast, the Fed loses a lot of credibility in the way they project those dot plots and in the way they communicate. Just quickly going through the CPI from last week. So what I think is that from what we see, obviously the trend is down and it's going nicely, but we're nowhere near 2.5 percentage points on CPI yet. It doesn't really scream like we need 50 basis points of cuts. And it's same for headline and core PCE. We had a sticky core PCE for 3 months now at 2.6, better than projected in the dot plot. But it doesn't scream like this can prove sticky, and it doesn't really scream like we need 50 basis point cuts, because there's always a risk of resurrection for core PCE, especially given the recent wage growth. Again, on an annualized basis, everything started deflating, and now there was a big bounce. We wouldn't say big, but there was a bounce in the last set of data, which essentially reduced the chance of a 50 basis point cut. And if you look at the non-farm payrolls at the beginning of the month, again, improved unemployment rate and 142,000 jobs, still pretty decent. And we did have a big revision for the previous 2 months, but we're not really in extremely worrying territory right now, especially given the improvement month on month. So actually, the data have improved since we had a market panic at the beginning of August. But the caveat is obviously the sum rule that got triggered, which is that unemployment rate is 50 basis points above the 12-month low. And every time it's touched this line, we had a recession, maybe except for a couple of times, actually, back in the late 1960s and late 1970s. So there have been exceptions, but I think for most of the time, we had recessions pretty much straight away. So that was the except that would be for the 50 basis point cuts. And again, hourly earnings improved last month in terms of CPI, which puts upward pressure on services inflation, and we saw that feed through in core CPI earlier last week. In terms of GDP, so recession is typically defined as a decline in GDP for at least 2 quarters. So technically, Q1, Q2, we had a recession, but the Fed and the government kind of denied it, saying it wasn't really a recession, blah, blah, blah. Fine, we came back. So past 2 quarters, we had 1.4 and 3% annualized growth for each quarter. And we're actually tracking 2.5% for this quarter, according to the Atlanta Fed. And the consensus, so this is the model produced by the Atlanta Fed. But if you look at the financial consensus, where they're drawing from the blue chip survey, still, like, no one is really predicting GDP going below 1% really, or even negative. So we are not in a recession for sure. That's kind of the textbook recession. We're definitely not in it. In fact, growth is pretty strong, which has been the Fed's argument actually for the past 12 months for not cutting rates. But what happened? So up until last Friday, really, the market has priced away the 50-point cut expectation. And so even after CPI, everyone really thought 25 basis point it is. Certainly I did. But Wall Street Journal wrote an article to say, the Fed prepares to lower rates with the size of first cut in doubt. And this is by Nick Timiraos. He's the same person who wrote an article to say the Fed likely to consider 75 basis point hike back in 2022, when the market priced in only 50 basis point of hike. At that time, it was the market reacted to his article because it was seen as the Fed kind of leaking an advanced signal to tell the market to realign their expectation, and the Fed wanted to go big, right? And so, very similar timing, he wrote an article to put the 25 basis point in doubt in Friday, and the market has reacted enormously since then. And again, I think on Monday, we had Bill Dudley, the former head of New York Fed for 10 years. He said the Fed should cut rates by 50 basis points, and he thinks it will. So you have a very senior formal Fed figure suggesting it would, Wall Street Journal suggesting it would, and I think there was another piece in Financial Times as well. It really felt like the Fed has told them to say something, because the Fed themselves cannot speak for 10 days in advance. And then you can see this chart. This is the Fed Fund futures for 2024, pricing in rate cuts. We had the August panic. We're pricing nearly 150 basis point of cuts. And then we had improved CPI data in line in that time. And the August non-farm payroll, the market had a bit of a wobble, couldn't really decide what to make of it, because better employment rate, but worse headline figures than expected. And you had a CPI kind of like this month pricing away the 50 basis point cut. And then the articles started to stream in. The market started reacting to those articles. And currently we're sitting on a 50% chance. So and also just to look at the 2-year bond rate. So 2-year bond rate versus the pink line, which is the Fed funds rate. And this is kind of the biggest deviation we've had in terms of undershooting. The 2-year bond yield is significantly leading the way in terms of rate cuts. Very, very bearish in terms of economic outlook. We haven't really had this type of bearishness from the past cycles. So it really feels like the bond market knows something that the stock market doesn't. So it's actually really hard to make of this. I think if the market priced in, let's say, 80% chance of 50 basis point, tomorrow is a done deal. The Fed might as well just go for the 50 basis point cut, because that's the path of least resistance. Just follow the market, and you could argue that the Fed is getting bullied into it, whatever. But the Fed, there's argument for and against, and the Fed just chooses one way that's the least path of least resistance. But given the 50-50 chance priced in, and if you actually look at all the big bank analysts and research, they're all very divided, and actually most of them are saying 25 basis points in terms of survey. It may just reflect that the Fed is actually truly undecided today going into this meeting. And instead of saying we want 50 basis point or 25 basis point, they want the market to understand that the voting members are truly debating this today, and it actually could really go either way. And they don't want to close the door for 50 basis points just because the market has pricing only 25. So there's a possibility. It hasn't happened in a while. Second possibility is that the Fed actually wants to do 50 basis point, and they just couldn't communicate well enough in advance. Jackson Hole missed the opportunity, or the Fed members were very wishy-washy in their own interviews. So they've just really miscommunicated, and they really tried to rely on the Wall Street article, the FT and Bloomberg, to communicate to the market that they want to do 50. There's a chance, but it's been semi-effective, right? And there's a big discrepancy between where the bond market thinks versus the economists. I think 90% of the economists surveyed think it's 25 basis point, but the bond market thinks the chance is higher. Typically, the bond market is where trillions of dollars of bets are being laid. So unfortunately, the economists might be smarter, but the bond market is way more powerful. So the bond market does have more sway just because of the sheer volume, the sheer size of that market. And between the two, in terms of coin toss, it's very easy for the Fed then just to follow the bond market and say, okay, fine, we'll just do the 50 then, rather than upsetting the market. All of these are possible. It's quite unclear. I haven't seen this case for a while, at least. So I think the best we can do is do a scenario analysis on what happens either way, so we're best prepared. So this is the base scenario. Jake, please unmute yourself and ask the question.
Hey, Yimin, I'm just wondering, whether it's 50 or whether it's 25, to me, doesn't seem to matter. What matters is what the market does in response.
Yeah.
And I was wondering if you're going to talk about that, or if not, what we can gauge from the close today, and anything else that might give us any hint of a direction.
Yeah, no, so I absolutely 100% agree that it's just theoretical academic on trying to predict whether it's 25 base 50 if we don't look at what could happen to the stock market. So we're going to cover that. So now we're moving on to the scenario analysis on what could potentially happen. So at the moment, the base scenario is what we just said at the beginning of the webinar. With a 25 basis point cut, I think the yield curve will price in lower. So 25 basis point for tomorrow. And I think all of these, and I think if the Fed wants to go 25, theoretically, that means they should want to do really 25 for the next 3-4 meetings, at least as a base case scenario. And we should price away the aggressive cuts that's been priced already. And vice versa, for the 50 basis point cuts, if the Fed does a really big one to begin with, it's really normal for the market to say, okay, I think the Fed wants to just cut as much as they can to normal rate or neutral rate. And then we're going to add more bets of cutting for the next 2 meetings. So in either cases, hawkish being the 25 basis point, because it's not cutting as much as the market thinks, dovish is at 50. I think the terminal rate yield will adjust upwards if it's in the 25 basis point case, which signals a 25 basis point yield difference to what we priced in. And for TLT, that means the price should drop by 4.7% or 5% in terms of price. So I think TLT is, let me just check where TLT is today. So TLT is 100, it should get down to something like 95. And for the dovish expectation, which is 50 basis point cuts, the total cuts will be, I think the market will even raise further to price terminal yield lower than what we have now. And the TLT, what it translates is that 27 basis point lower than the base case, and TLT could rally another 5%. So I think the chance is quite equal at the moment. Going into this meeting, we can look at the charts in a bit. I said I quite fancy 25 basis point, and therefore this scenario, and I think the bond TLT should retrace. It's from a technical point of view as well. But right now, the Wall Street article, etc., the latest development has thrown me off a little bit. So I just want to prepare both scenarios in case. So if they do the 50, I think TLT has room to rally. If they do 25, I'm happy to. If I haven't taken the profit, I would be happy to take profit and re-enter after it sells off. These are the three scenarios. The base case, 25 base. So today's pricing, 25 basis point cut versus the 50 for tomorrow. And then we just move on to the SPX and SPY analysis, including QQQ as well. And I'll kind of weave everything into this and how it kind of links. So just before we move into the actual analysis, I just want to flag that I've built a dashboard now for the components of SP500. So all of the 500 companies, 503 or 4 companies are in here, and you can see the individual contribution to the daily movement of the index as well. So if Meta has a big day and SPY moves up, you know exactly why SPY moved up and by how much coming from Meta. And again, this is another useful chart that's in the Google sheet. It shows the relative value in terms of PE versus growth for next year. And you can see Tesla has pretty bad, very expensive given the PE growth. Amazon, pretty good deal. NVDA, very good deal. LY, I don't cover, it's pharmaceutical company, so I don't cover it really. Costco, I don't really cover it. But you can see, you can have a play around and see these are the top 20 companies. So what's attractively priced versus not. So just getting into what may happen in the next 2 weeks after rate cuts. So far, the market has moved basically in line with seasonality. Very weak first week, bounced back quite strongly in the second week. And now going into this week, tomorrow is the FOMC meeting. Today's flattish, but from tomorrow onwards, just from a pure, seasonality point of view, we're going to have a very challenging 2 weeks. Maybe it gets easier towards second half of next week, but certainly after the FOMC, I expect headwinds. And you can see that as well from the historical performance of SP500 after the first cut in each cut cycle since 1990. First 10 days, very challenging. So I myself position quite light going into the FOMC. And I think towards the back, like in the final day of September or beginning of October, that might have a lot of value in picking up the dip. And another thing I want to share is that despite the short-term weakness, every time we had a strong first half of the year, we had a very good second half of the year for SPY. So I think the first half of the year, we had a 14% return for SPY, essentially above 8% We've never had a down second half of the year. So it makes me think that I don't see why this year would be different first. And it makes me think that the weakness from here should be recoverable, and we should head higher, at least in Q4. And if you just look at the quarterly performance, and here we looping in the rate cut scenarios back in here. First, if you look at this column here, so Q1, H1 performance versus H2, strong H1, strong H2, very strongly correlated. But also, when we had a very strong start of the year, first quarter, we had a very good Q4 as well. Q3 has always been challenging. And if you look at 1995, 1998, and 2019, where we had 75 basis points cuts in each of those 3 years, Q3, apart from 1995, has been not that great. 1998 sort of 10%, but it rallied back 21% in Q4. 2019, it was pretty much flat in Q3, and we had a pretty strong rally, 8% in a quarter for after the rate cuts. So I'm quite optimistic that the next one is a dip rather than the top being in place, and we're in a total doom and gloom scenario. Just looking at historical performances and seasonality factors alone. Similarly, for QQQ, every time we had pretty much more than 8% rally in H1, we had a positive return in H2, except for 1 year. Bear with me. And that 1 year was in 2018. So in 2019, when we had the last cut cycle, we had, again, challenging flat Q3 and then a rally in Q4. So I'm actually not that worried. We've seen this chart before. We have seen divergence, but so this divergence really comes from whether we have recession or not. The top four, except for the red line, which is the COVID, we didn't have a recession, and the bottom three we did. And the bottom three were .com, the Middle East Gulf War, and financial crisis. And I think from what we saw in GDP before, we had very strong growth trends. I don't think we are in recession. And my base expectation is this. So near-term sell-off, and we should really pick up in, from October, maybe November latest, onwards after the election, upwards going into next year. So now, just getting back to the 25 basis point versus 50. What I would say is that when we don't have a recession, and the Fed had cut by 25 each time, and then 75 in that calendar year, we had pretty good returns in equities market. But when they did decide to cut 50, and that's usually when we are heading into a recession, then things really started falling off in 2001 and 2007. So in 2001, we had 50, 50, 50, 50, 50 cuts. And this looks really familiar to what the market is pricing in now. The bond market is pricing this scenario currently, a string of 50 basis point cuts. And we're still actually quite close to the all-time high. So we're not quite here yet, but in the market, essentially .com bubble fell off a cliff afterwards. Again, in 2007, the rate cut started in 50 basis point cut, and then 25. And then we had essentially the subprime crisis, and equity market fell off the cliff. So we're here today. If the Fed cuts tomorrow, I would say that is the only drawback. I would say if they cut 50, and therefore it's likely because they think we are heading into a recession, etc., then this scenario can play out. So my base case, actually, personally, I think they should do 25 we're still in the soft landing scenario, or no landing, because the GDP is growing, and we can just carry on, essentially. Whereas if they start cutting 50, then my expectation has to change. And then I'm having to think that maybe we're in this scenario here. We haven't seen any economic science indicators apart from the SAM rule and the bond curve inversion yet. But my base case is essentially this: 25 basis point cuts and a temporary dip, and buy the dip and going up into the next 6 months. In terms of the Fed liquidity, so the liquidity, the blue line is the overall Fed liquidity, balance sheet, Treasury General Account, reverse repo, the bank term funding program. So overall, is actually picking up. So this going up means better liquidity, and that's correlated with stock market upturn, right? And I think the Treasury is going to hold some money apparently in the next 2 months. So this might get reduced a little bit, coinciding with the first rate cut. But overall, that trend should be going up as we're going into a cutting cycle. The Fed will be wary of reducing QT as well, because it doesn't really make sense to keep tightening your balance sheet using QT while also loosening financial conditions through rate cuts. So at some point, I think very soon, within the next six months, the Fed will also say, we're going to stop doing QT and just let it be. So the global liquidity should really turn up, and that should help equities after near-term headwinds. Similarly, the liquidity, the blue line, correlated very well in a negative way, negatively with the 10-year Treasury yield, because better liquidity means lower funding cost, lower cost of borrowing, et cetera, et cetera. And that relationship has pretty much held since July. So my base case is near-term pessimism, as in the next 2 weeks, maybe 1 month, and then medium-term optimism. We might get into a bigger sell-off next year. And it may happen. Remember, we had 2019 been cut, and then the equities rallied, and we had 2020 sell-off after COVID. But for the next 6 months, I honestly think we are heading down than heading up. So does that answer your question, Jake? Or have you got more questions given what we've discussed?
One of my questions is, how will the Fed how long does it take the Fed liquidity to actually affect markets?
So in terms of the rate cuts, typically there is a lag of 6 to 9 months, and it's not a precise science, and it's really hard to measure, because you can look at through the housing market, which has taken much longer for the liquidity to work through. But so in terms of just the rate cuts itself, in terms of the exercise I've done before, is 6 to 9 months. But this liquidity indicator is not just the rate cuts; it's the whole balance sheet, QE, QT, Treasury account, etc. And this impact is quite immediate. So this is live. This is no lag, right? So this is each week, each day, what the liquidity is as we measure using those metrics versus the stock market reaction. So I think this could go down. I think JP Morgan said we expect this to go down in September and going into October. But I don't see. But I think the longer term trend is that this will turn up, and that will have an immediate positive impact on the stock market. There shouldn't be really any lag at all. The rate cuts themselves do have a lag, which takes 6 to 9 months, because banks have to adjust down their lending rate, etc., mortgage rates, and that just takes longer mechanically to work through the economy. Does that help? Or do you have another question?
Yeah, I mean, I've looked at some of your charts and
Yeah,
obviously some of Alex's charts, and Alex sees a much more bullish scenario than you do. And if
yeah,
what we're seeing, I mean, the correlation, you look at the chart and it's quite obvious as liquidity goes down. I mean, you had that spike low in looks like June where it's inverted, but um,
yeah. So this
it
was
looks
kind of
like
like the carry trade area, right? So we had the carry trade. So this correlated, but then this kind of broke down because essentially the carry traders
yeah,
carry the market higher while the liquidity shrank. So there was a breakdown essentially from here all the way to here. And then essentially, and then basically the carry trader got busted in this area here. And then now this relationship has returned sort of in the past. And then this was risk off area. So carry traders got busted and we had essentially a month of risk off behavior. So lower yields and lower equity from here. And I would just say that I, I so I work out all those charts and also my technical analysis quite independently from Alex. And I think that's kind of where the value is, because otherwise you're just paying twice for the same analysis, right? So I don't I actually try not to look at his analysis per se as much, and this is sort of like a different angle from the macro angle, and just how I look at the long term trends, etc. I mean, he could be more correct. I mean, time will tell. But this is the thesis I'm going through right now from how I look at the markets in terms of liquidity and the macro impacts.
yeah, I'm trying to see if we
Yeah,
do end up seeing liquidity get go away in the next month. If there's this positive correlation that we're seeing play out, then your technical analysis, that would back up your technical analysis. It would make sense that we see
yeah,
a sell-off in the near term.
yeah. So yeah, so I think from a seasonality perspective, um, so this liquidity is obviously supportive of the bullishness, right? But from a seasonality perspective and historical returns on the first rate cuts, I find it very challenging to see how September ends up extremely positive. We still have 2 weeks to go, but from October onwards, I think that's a different ball game, and we can start again looking at okay, what's happened for the next between now and beginning of October, and what the October seasonality typically is, and how the fund liquidity. Because I track this every day, so we have updated fresh information essentially every day with a 2 day lag essentially, because some the TGA stuff doesn't come in until T+2. So we'll get much better information as we work through the next 2 weeks. All right. Um, do you mind if I move on to the charts then, the trading view charts? Okay. Let me just stop sharing. Okay, bear with me. There we go. All right. So I think we're on trading view now. Give me a shout if it's not working. So just start with this. In terms of what we had in the past 4 months, we had a monthly pattern where equities rallied into CPI and carried on for 4 days afterwards. Pretty much since May, it's been the same pattern. Up we go and consolidate. Up we go, sell off. Up we go, consolidate, and up we go again. And every time before CPI, I'll always say that if you're making money by next Tuesday, it doesn't hurt to take chips off the table. And here we go again in FOMC. And I don't think is any different this time around. This is another angle of seasonality. And it's yields the yields the same. After CPI yields higher, and then and the lower a few kind of at the beginning of the month. So I would be cautious as well, just looking at this pattern for the past 5 months. In terms of actual technical analysis, SPY, I think we are in a wave B. So we're in a wave B of this with the inverse with bracket B of wave 3. So again, I think essentially I think we're going to see a sell-off into this support area here, and then and rally into the bigger target of 610. If you're like if you're a buy and hold investor, and you're really not that bothered about this less than 10% dip, then there's nothing you should do essentially, and just wait for SPY and make new highs. What should start worrying you is if this start going under this wave 2 low, and then it suggests we could be in a bigger A, B, C down here, and we could be in a having topped already for SPY. So at the moment, I'm not troubled. I think this blue zone here, so 530 and 540 area, is quite a good area to buy the dip in terms of support. And that's my expectation. And the reason this B is above this A, where it started, is essentially expanded flat, where wave B is higher than where it started and wave C is lower than the wave A. And that's a similar pattern I see in QQQ as well. I see the market turning lower before we head much higher towards the year end. This is just saying it's a resistance because it's just overhead from the initial wave 1 here. Again, if we go below this wave 2 low, it's a very early warning sign that we might have topped, or there's a liquidity crunch, or there's something much bigger going on. In terms of TLT, my original expectation, so I actually haven't shifted this number 5 and C here for a long time. It's just been resting here. So I closed my long trade after the SPI on this day. It's made a new high because of the Wall Street article, etc., that were mentioned earlier in the webinar. Today is kind of losing steam a little bit because the market is kind of really suspicious. They're not fully convinced the Fed will 100% do 50 basis points. If they do 50 basis points, in our scenario analysis, we mentioned this has room to go all the way from here to above 104. And I think that would look something like that. So we can have an extended wave 5, and this might be 5 waves up to finish off. And if they don't, essentially we should have a sell-off. It might not be straight away to 95, but I would expect a sell-off to at least go below this wave 4 low in the coming few weeks. So it's quite a big dichotomy right now, and I don't think the risk reward is really that great for this leg up. I think if they do 50, we still have time and chance to add the long position over here anyway. So I'm not too worried. I'm not really rushing to bet a 50-50 bet anyway. So at this moment, TLH as well. Market corrected a little bit. TLH has a smaller duration than TLT. Therefore, it won't fall 5%. It will fall something like 3.5%, or rise 3.5% either way. Actually, just before I get on Bitcoin, does that help? Is everyone clear on my overall thesis in terms of expectation for yields and equity markets from everything we've analyzed so far. If you have any questions, I'm happy to answer it now before getting on to Bitcoin, because that's separate.
Yumin, you showed a chart where they had equities and bonds leading up to FOMC.
Yeah, it's the first chart here. Yeah.
So is your, from a very short-term perspective, is the expectation for the market, specifically equities, to go up here very short-term before heading down?
I think the room for upside is quite limited now. Because if you just look at this, I mean, it might consolidate, go flat, but if you just look at the past few month trend, the 4 to 5 sessions typically mark a short-term top. There's 5 sessions here in June and 3 sessions in July. We had 5 sessions and 6 sessions. Okay, so in August, it bounced back and consolidated slightly. But essentially, the 5th session is pretty much close to the top. And we are in the 5th session tomorrow. So tomorrow, the FOMC in the afternoon, we might get a little rally in the morning, but I think our base is essentially be quite cautious.
Gotcha. Okay. Yeah, actually, that's a failure on my part where I misread the yellow line versus the blue line. Thanks for that clarification.
No worries. Yeah. So the yellow line suggests CPI, and only this blue line is FOMC for tomorrow.
Got it. That's very helpful. Thank you.
No worries. Okay, so moving on to Bitcoin. Bitcoin has been very difficult to analyze in the short term. I want to show you my longer term expectation first. So we have a trade that's largely in place, but it feels much like a roller coaster. We entered here, it went up all the way to 65, and then down to 52, and then we're back up again. The black path is the path I see as a primary trend. We're trending up. And this, I will show you the short-term stuff in a second. But typically when the Fed cuts rates, it's actually quite helpful to have gold and Bitcoin versus stock portfolio. Because lower rates essentially reduces opportunity cost for holding non-income producing assets like gold and Bitcoin. When gold was held as bank reserve, as in the gold standard era, banks used to raise interest rates to lure people to sell gold to central bank and park their money to generate interest, and vice versa. They cut interest rate to get people to buy gold from central bank and encourage liquidity circulating in the economy. Bitcoin essentially is the same thing, in my opinion. It's a digital version of it. So I do think the Fed funds being cut is bullish for Bitcoin. It might not be like a tomorrow or the day after thing, but I think the longer term trend will be there. And also, the red path is the alternative path. So I think it's a lower probability for now. But if we breach through 49K, we could have much lower room, like 40 down to 41K. So these are my primary expectation. If the trading invalidates, I think we'll go much lower. Just on an even longer term scale, whoever gets elected in the next election, Harris or Trump, it doesn't matter. Let's forget whether they embrace Bitcoin for a second. Neither of them are really that bothered about reducing the debt deficit. And actually, both their policies likely add a few $1 trillion more debt. And if you think about the government as a borrower, the biggest borrower in the world, what favors the government? Low interest rate and high inflation, essentially. And essentially monetary debasement, because then the 35 to 40 trillion worth of debt would be worth less in real term. So just thinking from the ground scheme of things, and then this rate cut cycle, I do think Bitcoin hasn't topped. I don't think gold has topped. I think there is upside to gold. Gold has led the rally so far, with other central banks buying, but I do think Bitcoin should go up. The only thing is, if something like Tether gets investigated, the Tether gets found out they are not holding enough whatever money and they get busted, etc. That threatens the entire ecosystem, and the whole Bitcoin network loses faith in the whole thing, which is an existential threat rather than the market risk. That's a different story. But I'm just talking purely macro economy and the market risk point of view. I think the path is higher in the medium to long term. In the more short term, it's much harder to analyze the noise in the market. But essentially, ETFs have been underperforming in terms of they haven't really had much appetite in this area. They've been selling every day in beginning of September. We've seen early signs of funds returning, inflows returning, but it's still pretty muted, essentially. We dropped below this blue line, and we almost touched here, which is where below this is our stop loss. I did think they would retest this, but it didn't, which is actually really bullish. So if it retested this, it will be 5 waves down, which is quite bearish. But it didn't retest this, and we had 5 waves up from here. And again, I think this trend is pretty bullish. It just needs another retest. The reason I think it needs a retest is because we had 5 waves up, which is wave 1, but it's dropped. It's tested this line, it's held, which is good. But this one is a B wave rather than a motive wave because it's only got 3 waves up. So I do think we should test this blue line again. We could dip lower before heading higher. But the fact that it didn't reach this bottom, this blue zone, and it's bounced back really strongly, makes my overall target for wave 3 higher, essentially. So I think my primary expectation was head to 76K, either into the end or beginning of next year. It's really hard to tell in terms of timing, but that's my primary expectation still. In terms of gold, it's made a new high this week. I was still just, because the way it's rallied so strongly, I will still just wait for a pullback before entering for the final wave 5. That hasn't really changed much since we start covering at the beginning of August. So there's not much more to say about this. For silver, silver has also been quite tricky to analyze, actually. It made a new low here last Friday, or the Friday before. And I did think it would test 20, something like low 24s. It didn't. Again, that's bullish. It's actually made past the wave 1 high. But the way this gone up, I can barely even see 3 waves. So I do think it will have to retrace a little bit. And then once it retraces, I can better map out how it goes up for the next leg up. But overall, with gold and Bitcoin, I think silver is also going up. Unless we have a recession, which I don't think we are in a recession, which is the bottom line. The reason I mention that is that if we have a recession, typically people would prefer gold, which is a harder currency, and silver behaves much more like copper and lead commodities. So I don't think it's the case here. And actually, the gold-silver ratio has narrowed since we start covering silver. So this trade now, we entered at 20... Actually, let me just double check where we entered. We entered at 26 and it's at 28. So we're up 8% on that. I do expect a short-term retrace, and then we can map out what happens next. So finally, getting into the Magnificent Sevens, I'm just going to do them alphabetically rather than from the most exciting to least exciting. So Apple is already, I think Apple has led this move so far. It's already in wave C. I think it's peaked already in terms of wave B. And I think going into the year end, the iPhone 16 sales numbers were coming, etc. That narrative could support Apple heading higher for next year. But I don't have a trade set up yet. So I think best entry is below 190. And when the time comes, I'll do the trade. Amazon has pushed higher. So initially I did expect to have ABC here, but actually seemed to have pushed higher in a more extended fashion. So I'm not chasing here. I wouldn't mind a pullback with the broader market, and so we can re-enter this trade. We can actually enter this trade at 164. But in absence of any sort of topping signs, etc., I wouldn't short it. I would just have to wait patiently for the next pullback and see where it brings. So at the moment, it's slipping away from us into this trade setup. Google, I think we're not done yet. I think Google has topped in wave 1 in July, and I think we're in wave C. So the recent rally is basically a wave 2 bounce to the downside. I could be wrong, and if I'm wrong, then we should see Google rally above this wave B, and then we can see 5 waves up essentially, and then we can go from there. But my primary expectation is still down. Valuation wise, I think Google is quite fair now. So getting down here is actually quite cheap. And if you think about it, it's basically essentially nearly halving from the top. So Google, I think, is a very good opportunity to buy in this area here. Meta, it didn't really get into our trade setup, and it's starting to move towards wave 3. I think it might actually just move towards wave 3 now, instead of wave short-term pullback. And I expect much higher for Meta into next year. Microsoft is one of the companies that I could have been wrong in my previous analysis, given the strength of the rally, but still, this wave looks like a B wave because we only have A, B, C, 3 waves set up. So unless it can really show 5 waves up, I feel we're still in an overall downtrend. So B wave, and we could start wave C some point soon. The alternative is that we've already bottomed in wave 4, actually. So the alternative is that the Microsoft hasn't topped yet. And this is actually just extended wave 3, and wave 5 is all the way here. That could be true. I just really need this to show 5 waves up and 3 waves down for me to give me that conviction, and we can set up the trade against this August low. Otherwise, I do expect further downside. NVDA has worked quite well against our technical analysis, actually, because when I forgot who it was who asked me on this Friday, someone said, "Oh, do you think NVIDIA has bottomed and could bounce?" And I said, technically, it completed all of the 5 waves down, and it has room to bounce to wave 2 in this region, and it's pretty much topped at just below what I had marked over here. So I do think now we're in further wave 3 down, potentially competing wave C at mid 70s. What could getting below this wave A is the biggest confirmation, but making a new high obviously would invalidate the trade, or even above this wave B could invalidate the trade. Do you think the risk reward of shorting this is probably better for against wave B high versus wave 3? But I don't like shorting equities, especially given how often they rally versus they fall. So I don't think generally, conceptually, shorting is not good risk reward for me. So I wouldn't go into too much on that. Finally, and I just want to say that in terms of stocks, I do have a divergent view to Alex. And the reason I have a divergent view, again, the reason I have a divergent view because I look at the charts completely independently. So you get different views, which is great for the value of the service. But also we are building a head and shoulder here with a neckline over here. So if it really dips below this, I do think stocks can have much further downside. Obviously, going above wave B high and wave A could invalidate this thesis, which is a different story. But it does feel very much like a head and shoulder, and this is wave B rather, and it kind of lost steam over here to the down. So NVDA and stocks, I'm slightly bearish in the near term, which might be different to what other people are seeing. And finally, Tesla, I do think again, expanded flat. So wave B slightly above the beginning and wave C below wave A. It's been very difficult stock to trade in terms of short term because it's just how volatile it is. But I think once we get to here, if it gets to here, just above 200 is a really good opportunity for going long. In the longer term, I'm very bullish for Tesla, and that's unsupported by fundamentals. So if you look at where the PE, remember the chart I had before for PE ratio versus growth, Tesla is like the most expensive stock with worse growth prospect. That's completely true, and that's also true in my fundamental analysis. But the market seems to be building up to a new high, maybe not like a new near-term high. And I mean, it would take invalidation below this wave 2 and this wave 2 here to say otherwise. But my primary perspective is here. How exactly is Tesla going to do it? To be honest, there's a few things that. So, in terms of election, I actually think it has made me think that Tesla could be a Trump trade, which is counterintuitive because it's a clean energy car company, etc. But if you think about how Tesla fared under Biden-Harris, he's not really a top guest at the White House. When they invite all the top electric vehicle makers, they don't invite Elon Musk to the White House. And he's been very vocal and critical towards the Biden administration. And he's been a big sponsor for Trump. So if Trump gets in the White House, one way or the other, it might be that the Trump's policy hurts his competitors more, Elon's competitors more, or there's some other ways. I do think Tesla is actually a Trump trade. If you just think about the fact that he's the richest man in the world, and he's not waking up every day to support Trump without getting something in return, and he wouldn't get to become the richest man in the world without understanding how the world works. So I would. What he does makes me wonder that there is some upside for him personally as well as his companies when Trump gets in the office. So I think that's it in terms of all my analysis for today. Does anyone have any questions before we drop off? It could be anything from the data from the previous slides or the charts, etc., or just a new area of topic. Okay, brilliant. So let me just get back to here.
Yemen, I got one. You provided the inflows and outflows. Is that, I mean, I know that's just another data point to consider the macro context, but I assume that goes into your analysis when you contemplate where the market's headed.
Are you talking about Bitcoin especially, or are you talking about ETFs generally?
Just in general.
So generally, I can actually share this. Let me. So this is the page we're talking about, I think. So the way I've set this up is to look at, there's some hidden cells here to work out what the asset under management before the fund flow, so we get a correct number. The way I like to think is how much of inflows relative to AUM we're getting rather than the dollar number. Because if you look at the dollar number, SPY, QQ will always be the biggest because the biggest funds. And for me, these signals are more secondary. Because there are days like yesterday when Bitcoin fell a lot, and it was quite muted in the flows, because fund flows don't explain everything. There are days where fund flow is positive and then price action is negative. I think it's useful to look at the longer term trade. I think the 1 month and 1 quarter where investors are positioned. But for me, it's a secondary indicator that's helpful. Sometimes it explains. So for Bitcoin, it does explain the recent sell-off because there was a huge outflow in the ETFs. But I wouldn't say it explains 100% everything. And also, I'll be honest, this is something I also start looking at a bit more recently as well. So thank you for requesting this type of things, and please keep them coming. There's a lot of things I previously didn't look at, and I'm still learning with you guys on the way. I'm building all those different tabs that may be useful, may not be useful. But I think it's one of those things where as we progress towards the journey, we'll find out in real time what's useful, what's not. So yeah. Maybe I have a better answer in a month's time.
Yeah, this is helpful.
Okay.
I mean, just looking at oil, for example, you see huge inflows into oil on that monthly basis, 25%, for example, USO.
Yeah, USO. Let me just go here. So, yeah. So I think I did think that because there were some inflow days where oil was down, but oil prices have been pretty miserable in the past 2-3 months, right? So it could be people positioning to buy the dip, which is supportive. And I think there could be a way to play this, and there are people who play this in terms of positioning, is that if all of these outflows are really negative in terms of long term, and if you can only buy long, right, you want to start buying when the short-term signals pick up on the positive side. So let's say this is -25, -50, and this suddenly becomes +5, +10. I think that's, you kind of know, okay, investors are buying the dip here, and they are, etc. And I think that's probably a much more effective way of playing this. Yeah, so that's something we can try. Actually, we can monitor every day, and we can flag and say, what's being positioned weak and whatever. I think that's something we can play with. Yeah, for sure.
Yeah. Okay. Yeah, the oil and natural gas, those two right there are just good examples of where they're huge buying, and it's at pretty relative lows currently.
Yeah, exactly. Yeah, so it does make me think, and I think some of that is obviously the US is producing a lot more oil, and also apparently US has. Look, I'm not an oil expert, but apparently they've been producing as much as Saudi Arabia recently. So there's a supply influx, and also there is global recessionary warnings, and China has been on the weak footing recently. So that, I think, if the recession warnings start to wane, as in people don't think we have a recession, maybe in terms of that, oil prices can rebound. To me, I haven't studied enough to have a view on it per se, but it's something I'll try to pick up in the next few months. Yeah.
Yeah. Thanks for providing this data. It's helpful to me. Appreciate it.
No worries. Yeah. So just while I have you guys here, there is a tab on the second tab here. I deliberately put it very much front. If you have any ideas, tickers or whatever sort of data you want me to look at, you can put it here. I can't guarantee I look at everything, because there are sometimes, if it's really completely not relevant to the service, then I won't look at it. But a lot of things have been very helpful, so I will try to look at them as much as I can, especially on Tuesdays before the webinar. I spend a lot of time looking for patterns, historic returns, etc., and out-of-box ideas. So I really appreciate if you guys have a look around and put your ideas down. It will benefit everyone. So, okay, I think if that's it from everyone, thank you for joining today, as usual. and I'll put on the recording up later tonight. And with FOMC, I think I'll write an article on the FOMC the day after, on Thursday. I see a setup potentially in CRM, so I'm going to focus on that next. And tomorrow evening, I'm covering FOMC live during the press conference, so I'll be active in chats, etc. I'll be contributing to the Seeking Alpha news, so they call me on the press conference. So I will share that with you guys as well. So yeah, speak soon. Any questions, just ping me on Slack. All right.